We are talking about Chapter 4, Accounting for Merchandising Operations. Let's look at describing merchandising activities and identify income components for a merchandising company. So first, service companies versus merchandising companies. Service organizations sell what? Services or time. Those services are based on time. So a plumber comes in, charges you based on time that he or she are going to spend serving your plumbing problems. You go to your accountant right now and you're getting your taxes prepared. That fee is based off of time. But a merchandiser receives revenue by what? Selling goods, buying, hopefully buying merchandise and selling it for a higher profit. So with a merchandising company, know that we have the manufacturer. Let's look at the flow of goods. We have the manufacturer of an item. After it's manufactured, where does it go? To a distributor or a wholesaler. From there, where does it flow?
Retailer.
To a retailer. And then from there on to the consumer. So think of you shopping for clothes. You go into the department store. You are the consumer. The department store is the retailer. That department store received its goods from a wholesaler. Most likely someone who brought those items into the country. That wholesaler received those items from the manufacturer. All right, so let's look at the operating cycle for a merchandiser. Exhibit 4.3. We see how this is going to be a perpetual circle. Cash. How's cash flowing?
In now.
Well, cash first is used to acquire merchandise inventory. Credit sales after we get the inventory. So cash is going to be here. It's going to flow into inventory. That inventory is therefore going to be sold. And after that sale is complete, what do we have to do? We have to receive cash for that sale. So accounts receivable. So for each sale, cash to inventory, to sales, to accounts receivable, and back to cash. Let's look at two different types of inventory systems and tell me, what is a perpetual inventory system?
Continually updates accounting records for merchandising transactions.
Continually updates accounting records for merchandise transactions. Compare that to a periodic system.
Updates accounting records for merchandise transactions only at the end of the period. Records
are only updated at the end of the accounting period. All right, so let's look at an example. On November 2nd, Z-Mart purchases $1,200 worth of inventory for cash. How are we going to record this?
Merchandise inventory cash.
Merchandise inventory, we are going to debit. Cash, we are going to credit. Does my accounting equation equal?
Yes.
Yes. The assets are going to cancel each other out. I debit inventory to increase it. I credit cash to decrease it. All right, now purchase discounts. Exhibit 4.6. What's a purchase discount?
Term used by a purchaser to describe a cash discount granted to the purchaser for paying within the discount period.
Cash, we're trying to encourage prompt payment. Think of that merchandiser. Think of anyone who is selling on accounts receivable. Cash goes out, remember, cash goes out to inventory. It then goes out to sales. But what must occur before cash is back in our pocket? We have to collect that cash. So for a merchandiser or anyone who is operating under accounts receivable, this becomes the area of attention. We've exhausted cash through half of the process, 3/4 of the process. We must collect it. Otherwise, we're spending money and never receiving it back. We're not getting that margin. Okay, 2/10, net 30. So you might sometimes see something that looks like this. This is going to suggest a 2% discount if paid within 10 days. Otherwise, the full amount is due within 30. So on November 2nd, Z-Mart is going to purchase $1,200 of merchandise on account. Credit terms are 2/10, net 30. How are we going to account for this?
So you're gonna put the accounts payable. You're gonna put merchandise inventory and then cash.
Okay, merchandise inventory, our asset. We're debiting or crediting it? We're debiting it. We want to increase it. How are we going to balance this equation? By crediting accounts payable. So when that merchandise is first received, we know we owe $1,200. And what you're seeing in an example is your journal. All right, now on November 12th, so let's go back here. We would say that on November 2nd, what do we say? Merchandise inventory of $1,200 and accounts payable for $1,200. Keep it all in here. All right, so now on, let's see here, let's speed it up and say on November 12th, we pay the amount due on the purchase. Do I get the discount?
Yes, you paid it within 10 days.
So on November 12th, I pay it within the allowed 10 days, so I am going to get a 2% discount. So now I've got to reduce this accounts payable. So I paid the $1,200. How am I going to balance my equation?
The merchandise inventory, because it's the 2% by 12, multiplied by 1,200 gives you $24.
So merchandise and then what?
$24.
This is your 2%. Then how much cash am I actually paying? The balance.
$1,176.
$1,176. Actually, I'd be crediting this. Make sure it's picked up on the screen. It's important that we show what amount we received in the form of the discount.
Unless it wouldn't balance out, but we have to show it on there.
Otherwise, it wouldn't balance out. But also, if I'm looking at this real quick, I can see where I took advantage of a trade discount.
So ideally, if you're Z-Mart, you're gonna wanna try and pay that off early so that you can sell it for the same price and make more of like a profit. Like,
If you receive this 2%, yes, I mean, that 2% ultimately would flow if your selling price is fixed.
so if the shirt's $80,
it's $80. But then if I pay it off early, then it's paid for and I collect more. Do you get what I'm saying?
If you take advantage of this trade discount, you get a 2%. Yes, that 2% would flow over and say that your selling percentage, your percent margin is going to increase by 2%.
Okay.
Now, the question would always come down to, one, do I have the cash to pay this in advance? Two, is that cash in ready form, or must I maneuver it somehow to get it in the liquid form? So first, do I have the asset to pay for it? Secondly, can I easily maneuver that asset to cash? Let's just assume I'm holding the cash and I can pay for it. The question I would ask as a finance person is, do I have a better alternative for that cash within 10 days? Is there something else that I could use that cash for within 10 days in order to earn an incentive or receive an incentive? Is there an incentive greater than this one for that cash within those 10 days? All right, let's look at returns and allowances. Anybody ever return something to the store?
Yeah.
All right, let's look at what goes on here. Oh, a lot of little chuckles right there. Yeah, little devilish.
That's why you leave the tags on it, wear that dress to the function, they return it, say it's not what you wanted.
Well,
Make sure you don't have the deodorant stains on it.
all right, girl. Go ahead.
I was in a sorority for a little bit. We had to buy stupid dresses that were color themed all the time. My daddy didn't pay for my school. I had to pay for it out of pocket. I was like, no, better believe I did it.
Just call it stealing.
That's not stealing.
Is that still?
I just
Let's
returned it.
take that. That would be a conversation.
I
we'd have
borrowed
in-
it for an hour.
That's a conversation we would have in an ethics class.
Borrowed it for an hour.
I'm
Function.
thankful.
Technically, it's not theft because she purchased the item.
I was in a fraternity. We had to buy suits, and I was just thankful that those suits followed me out of college into professional settings. Oh, the advantages of being. Save that for another class when I'm not outnumbered. All right, purchase returns and allowances. A purchase return, we're going to assume merchandise returned by the purchaser to the supplier. An allowance, a reduction in the cost of defective or unacceptable merchandise received by the purchaser from the supplier. A reduction in the cost of defective or unacceptable merchandise received by the purchaser by the supplier. Now let's think, why would we do that? All right, so on November 15th, Z-Mart is the buyer. He's going to issue a $300 debit memorandum for an allowance for defective merchandise. Okay, so they've received some defective merchandise, but it's probably still operational. It might not be totally broke down. And they've got the asset and they figured that they'll just keep it, but they'll not pay full price for it. So accounts payable, we notice we're going to debit accounts payable by $300. And we're going to credit merchandise inventory by $300. We're debiting the liability account, crediting the asset. Now, on June 1st, $1,000 of merchandise is returned. Or let's start here, $1,000 of merchandise is sold with 2/10, N/60, 2% discount. If paid within 10 days, full amount is due within 60 days. 2 days after the sale, Z-Mart returns $100 of goods before paying the invoice. When Z-Mart later pays on June 11th, it takes the 2% discount on what? The remaining $900. So what happens on June 1? We purchase $1,000 worth of goods. 2 days later, I return $100. That discount is only going to apply on the invoice that I pay. I come back later in, 10 days, and I make that payment. I'm only going to apply that 2% discount on the amount that I pay. All right, let's look at two terms. What's FOB?
Free on board. Who pays transportation costs?
All right, who's gonna pay the transportation costs? All right, when we're talking about shipping point. All right, these are important terms to know if you ever find yourself in a purchasing role. If something is shipped, FOB shipping point, when is ownership transferred?
When we will place the sellers of this business.
Okay, ownership transfers when goods are passed to the carrier,
Once they deliver.
once they're delivered. What about destination? Ownership is transferred when goods are passed to the buyer. Now that's important because again, if something is shipped, you need to know as the buyer, when do you take ownership of it? If you don't take ownership until it's delivered to you,
Mhm.
you're not responsible for anything that happens during the delivery.
Right.
So from manufacturer to retailer, you are not responsible for it.
Right?
But if you were taking ownership at the time it leaves the manufacturer, you're gonna have to take measures and probably insure that operation to be ensured that you get a quality product ready to be sold. All right, Z-Mart purchases merchandise on terms, FOB shipping point, transportation charge is $75. Are they gonna incur the cost?
Yes, because no. No, because at that point,
They're
it's,
not responsible.
yes, the sellers owns the goods.
What's your question again?
Are you set up? You're still mic'd, you're muted, we can't hear you.
I had to get a computer.
I know, I saw him come in there, I said, are you set up?
Not at all. No, I just got completely signed in, so.
What happened to the old one?
It's my computer and it sucks.
Nothing like honesty, we appreciate it here.
Definitely not the quality it needs to be.
All right, so Z-Mart purchases merchandise on terms, FOB shipping point, transportation charge is $75. What's happening?
The seller is responsible for it because the FOB is destination. So Z-Mart is not responsible for paying the cost. Isn't that your question?
Here's the shipping point, right? So yes, they are responsible.
According to the question,
The shipping point, the buyer is responsible during transit.
according to the question, according to the example here, it says November 2nd is on terms of FOB destination. FOB destination, the goods in transit are owned by the seller.
Yes,
Z-Mart is not responsible for paying transportation costs.
but he said shipping point.
Shipping point.
Ah,
He wasn't reading that, yeah. He was trying to trick us.
The example, Z-Mart purchases merchandise on terms of FOB shipping point. The transportation charge is $75.
then yes, Z-Mart is responsible.
Z-Mart is responsible for the charge. Just look at the example and you see where, what are we doing to merchandise inventory?
Did you tell me to pay attention? Is that what you just said to me?
On November 24th, we are going to show a debit to merchandise for $75. Crediting cash. So again, that charge, what we see by debiting it is we're putting that on top of merchandise inventory. That must be included in your inventory because it is a cost of that inventory. And of course, we're gonna credit cash or reduce cash to show the payment. All right, let's look at an example of, let's flip all the way over to section 2. Analyze and record transactions for merchandise sales using a perpetual system. And look at exhibit 4.9. You with me?
Yep.
What page is that on? 173? Thank you. So page 173, we see Z-Mart. Computation of gross profit for the year ended December 31st, 2015. What's our gross profit?
84,000.
So I know that on sales of $321,000, I have a gross profit of $84,300. So we'll come down here and say that of $84,300. The sales up here at the top. Dry some, but we'll say sales were 321,000. All right, flip over. Sales transaction for a seller involves 2 parts. Who can tell me those?
Revenue received in the form of an asset from the customer, the cost of goods sold incurred for merchandise sold to.
Revenue received in the form of an asset from the customer. So think, each sales transaction is going to involve these 2 parts. Revenue received in the form of an asset. So the retailer takes in cash from the customer. That cash is an asset. Second, recognition of the cost of merchandise sold to the customer. Okay, remember that expense recognition. Once I receive that cash, I need to match up the expenses that were incurred in order to earn that cash. So as an example, Z-Mart sells $2,400 of merchandise on credit. Has a cost basis. What's that term? That's our cost associated. So the merchandise has a cost basis of $1,600. All right, so let's look at this example. So we sell. I don't know where it is. So $2,400, and it's on credit. And what's the cost?
$1,600.
So the cost is $1,600. All right, 2 entries are required, and what are those? Remember, we first have to recognize the cash that's received from the customer.
So your accounts receivable and your sales?
So 2,400, so on 1, accounts receivable would be 2,400. And we would credit sales for 2,400. What do we recognize in the second entry?
Cost of goods.
The cost associated with that sale. I always abbreviate that by COGS. So if you see that, cost of goods sold. So the cost of goods sold was
$1,600.
$1,600. Now merchandise inventory we are going to credit by 1,600. Question?
Yeah, there you go. Thank you.
All right, let's look at another example. Returns and allowances. We're going to come back here and look at how we record these. So think about when you wear that dress one time and you take that back to the store. We'll save the debate whether or not that is, as one of you called it, theft, I think, or stealing. We'll save that for ethics, but let's just think about the extra work that's created by the accounting department. All right, sales returns and allowances usually involve dissatisfied customers. In some of your cases, shameless customers. Dissatisfied customers and the possibility of lost future sales. All right, sales returns refer to merchandise that customers return after the sale date. Sales allowances refer to reductions in the selling price of merchandise sold to customers. Okay, just don't split them. Sorry. Recall Z-Mark a while ago. We sold $2,400. And the cost was $1,600. The return, okay, so recall, assume the customer returns parts of the merchandise. The returned items, so of this $2,400, they're going to return items selling for $800. So we're going to return $800. Now the cost associated with the returned items was called $600. Something sounds good. All right, so what are we going to do first?
Stress relief.
What's the first entry? Still going to require 2 entries here.
The return of sales, $800.
You're going to have to take the sales that we had previously. So the first one, we're going to have to debit $800 because we're going to have to reduce the sales that we just showed in the previous slide. Now, what are we going to credit?
800.
In which account?
Accounts receivable.
Accounts receivable. We're not going to receive that $800. So I don't want to show an accounts receivable of $2,400. I need to show an entry that would reduce that. What's the next account?
Merchandise inventory.
So remember, we must record the cash received from the customer and then the cost associated with that cash. All right, so our cost of $600.
It shows it the other way around. It says the merchandise inventory and then the cost of goods sold. Okay, I'm sorry. I was just going with what you were doing, but go ahead.
All right, now the cost associated of that 600, where are we going to pull that from? And ask yourself each time you're doing this, remember that equation. And just always ask, are you in balance? Remember the principles of double entry. All right, so we're not going to receive that. We're going to pull that, offset the cost of goods sold. We've got to show where did this cost come from? Well, the inventory, we incurred a cost of $600 into inventory that sold for $800. Questions?
A lot going on. Brain kinda hurts.
All right, let's flip over to presentation 3. Yeah, all right.
You were saying presentation 3, P3, okay. Sorry.
All right, adjusting entries. So now let's look at adjusting entries. Merchandisers using a perpetual inventory system is usually required to what?
Keep up with like every change.
Keep up with every change.
It's not at the end of the period, it's like just a continuing cycle of keeping everything.
Well, we do know that under a perpetual system, everything is going to update. But when we talk
There we
about
go.
adjusting entries, remember those adjusting entries from the last chapter. All right, on December 31st, and adjusting entries are usually done at the end. Notice how we're now showing these done on December 31st. We're starting our closing process here. And so on December 31st, what are we doing? And specifically, let's not look at the amounts right now. Let's just look at the accounts that are in function. Cost of goods sold. And what are we pairing that with? Merchandise inventory. Remember, you're always wanting to know the cost that was associated with earning the revenue off of that inventory. We're trying to match the costs that were incurred into earning that revenue. And finally, let's go over to Exhibit 4.13 and look at an income statement. So if you're faced with an income statement and you're looking at one, what do you need to know before you can calculate gross profit? Net sales. Well, you're going to take sales less any discounts, less any returns and allowances. We're going to take net sales, and then what must we subtract out from net sales? The cost of goods sold. So the cost associated with those net sales. This is going to give you the gross profit. Companies will concern themselves with the gross profit because what do you then do with gross profit?
Your operating expenses.
You pay all your operating expenses. And what are some of those operating expenses?
Then, general and administrative expenses.
Rent, general and admin, advertising. See salaries. Yes. This is what we would refer to as discretionary. So this is what the employer, or excuse me, this is what the retailer is going to have in order to pay all their operating expenses. This is where they're going to base hiring decisions, staffing questions, raises, RIFs. Y'all know what a RIF is?
Reduction in force.
Reduction in force. All right, so this is where this information is going to come from. Because even though sales are being earned, everything that's associated, directly associated with that sale has to be taken into consideration first. It has to be generated before we even make that sale. So notice even the cost, the labor cost that would be associated directly with selling that merchandise, that's still going to be included up in cost of goods sold. Any cost that's associated and directly linked to that sale. What is left over is what we have, the gross profit is what we have available to us to pay our operating expenses. And you see income from operations. And then you see finally non-operating activities. All right, the first one, all that's going to be related to operations of the business. And then look at non-operating, interest revenue, gain on the sale of building. Okay, here they sold a building, but interest that they received that interest not on any operation. And that would be cash that they held. Interest expense. That's what they paid out on borrowed funds, but again, that had nothing to do with operations. Or I don't want to say nothing to do, but we'll say directly nothing to do. Next is going to follow a single step income statement. I'm not showing you anything different here that we've not looked at already. We're looking at a balance sheet. Again, I pointed out in prior videos, assets on the top. How are those assets arranged? By liquidity. So the most liquid are going to be up on the top, less liquid down at the bottom. Usually you'll always see cash up at the top. All right, let's end with our global view. What's the global view for accounting for merchandise purchases and sales?
They're identical.
Both the U.S. GAAP and the International Financial Standards include broad and similar guidance for the accounting of merchandise purchases and sales. Both income statements under both jurisdictions are going to start with net sales or net revenues up on the top line. All right, sometimes you're going to hear that referred to as top line revenue. For merchandisers and manufacturers, this is followed by the cost of goods sold. And the presentation of the following items includes order of expenses, separation disclosures, presentation of expenses, operating income, and any alternative income. That alternative income component is added there. Again, when reporting, you would want to disclose, you wouldn't want any investor looking, if you had an alternate source of income for that period that inflated or even reduced your net income, you would want to disclose that and spell that out on a separate item. That way anyone looking at that would be able to distinguish, less likely to see that as a reoccurring in the next reporting period. All right, two ratios. Then we're going to talk about an acid test. And how do we define the acid test ratio? What's a quick asset? Cash. So it's quick assets divided by current liabilities. And we define quick assets, anything that we can, the most liquid, what can we put our hands on quickly? Cash and any short-term investments. And when you think about short-term investments, we're probably talking about cash that's sitting in a reserve account, cash that is sitting in a savings account, cash that is sitting in probably something less than 30 days. You know, if we're talking large sums of money, if we're talking about Fortune 100 companies or Fortune 500 companies, wouldn't be out of the ordinary that they make investments for 30 days. You know, in Apple's case, you're sitting on $433 billion, let's say. Hey, $433 billion can earn some interest in 30 days. So again, the quick, always think of quick. How quickly can we put our hands on it? And how quickly could we take that cash and satisfy current liabilities? And again, companies like to take a look at this. This is a security measure. You know, I often in practice, I periodically go in and calculate our firm's quick ratio. While I never expected, I like to know that if I saw all the way down decrease in revenue, how long could I keep business operations going? So companies are looking at ways that if they saw a reduction in sales, how quickly could we keep operations going before we had to start taking other long-term measures? Either to raise cash, meaning start selling some other long-term assets. I mean, the only way we can raise the bottom line is to increase revenues or cut expenses. So this would be a good measure to know how quickly we could maintain operations based on our liquid form. Your book gives you an example of JCPenney's asset test and current ratios. Be very interesting. I can tell you just in the financial state of JCPenney right now, this book was published in 2015. I would even say going forward 2 years. I would even say take the end of year data from last year, 2016, and compare those numbers to what's shown there in the book. Okay, JCPenney's is kind of took a hit in the last few years. And that's my close. Questions?
I got one that ain't really pertaining to the lesson, but when we have certain classes, why do they span them out? Because some of this stuff is coming back to me from my consumer math class or whatever it was, like when I first started. So now it's like I didn't use that until now. So do you know why they span stuff like that instead of like taking that basic class last term and then we get accounting so it can kind of be fresh in our mind and know how to really use that and apply it?
How would we use it and apply it?